We're best described as a bottom-up stock-picking house. I would say that 80% of our portfolio positioning is driven by bottom-up, high-conviction recovery PVT ideas. We do have a top-down overlay framework, which we call the stock market cycle, which basically looks to identify where we are in the cycle. And we'd typically like to be more aggressive towards the beginning of the cycle when opportunities are that much more significant, and be more cautious towards the end of the cycle. So that's the top-down element of what we do. Bottom-up stock picking. There are occasions though when there's a clustering of high conviction individual stock picks within the same sector, and that will make us high conviction about that sector. For example, if you look at the mining companies back in 2016, a lot of them were scoring really highly within the recovery screen, the money penny recovery screens. That made us high conviction about that particular sector at that point in time. Unfortunately, the fund has performed well over the last few years. We launched the strategy at the height of the global financial crisis to exploit all the anomalies that were available then, and the strategy has generated strong absolute and relative returns since we launched it, outperforming by over 5% per annum over the last 10 years, for example, and being in the top decile of our peer group over that same period of time. Our focus is on maximising long-term wealth creation, and that's what we do day in, day out, focus on maximising long-term wealth creation. I think most value recovery investors are positive about UK banks, would typically be overweight UK banks, and we're in the same position. If you look at the last few years, UK banks have classically recovered their profitability and are now generally earning an attractive return on equity, or on a path towards earning attractive return on equity. That's allowing them to throw off a significant amount of free capital, excess capital, which they're distributing back to shareholders in the form of really attractive dividend levels or share buybacks. So the underlying recovery fundamentals from our perspective are strong today, and that's combined with a really attractive valuation. So UK banking sector trading typically at a big discount to book value and on single digit earnings multiples. So we do like UK banks, and that includes our preferred bank, Lloyds, very strong market position, well capitalised, attractive valuation as we see it today. Though I'd like to say that the fund isn't just focused on UK banks as part of the portfolio, and the many other attractive recovery PVT ideas elsewhere. We are bullish on UK equities. If you look at the valuations of UK shares, they're trading at just over 11 times earnings multiple, with a really attractive dividend yield, almost 5% dividend yield. So that's cheap in an absolute perspective, and cheap relative to the history of UK equities, and cheap relative to other equity markets around the world, and also cheap compared to fixed interest, for example, UK government gilt. So the absolute valuation is we think, attractive. Obviously at the moment we're a little bit handicapped in terms of the uncertainty regarding Brexit. As that uncertainty is removed, we would expect UK shares to do well. And then focusing on the UK recovery strategy, it's trading valued particularly cheaply at only 1.2 times price to book, with a PE multiple that's less than the benchmark, so really well positioned from a valuation perspective. We're seeing buying opportunities across a wide range of recovery PVT stocks and sectors. So just to give a flavour, we do like banks. We're overweight banks. We have quite broad exposure to financials. So for example, we've found our competitors really quite attractive investments at the moment. So the fund manager space in the UK and outside of the UK as attractive. They've been derated significantly because of the uncertainty associated with equity markets, and because of additional competition from the passive side, ETF side. But that's left high quality businesses looking really attractive. We like oil services, for example. So this is a classic recovery sector. The oil price has rallied from a low point. The big oil companies have got a lot of cash flow that they're throwing off. they need to invest in order to keep their production stable at the current level. That will really benefit the oil services companies. So that's the flavour in terms of some of the sectors that we're attracted to at the moment.